Hello, my audit friends. Now is the time to give a quick run through on audit reports. This is its snapshot version. Now, I know at this point we get to appreciate that the audit report becomes kind of like the final output of the auditor, right? And when we talk about the final output, what better way to appreciate it even more than to go back to the very beginning. And the very beginning, of course, would refer to the overall objectives of the auditor. So if we take a look at our PSAs, this is what it will give us when we ask what is the overall objectives of the auditor in performing an external FS audit. Now, this might appear too wordy and too lengthy, so let's just highlight some very important words or phrases in this provision of the PSA. So the overall objectives of the auditor are essentially to express an opinion and to report on the financial statements. Therefore, when we take a look at audit reports, we are looking at two very important components. The first component of which is of course the audit opinion itself, and the other component is the audit report. Because again, the overall objectives is twofold: to express the opinion and to report on the financial statements. Now, this audit opinion is given by the auditor about whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework. So, previously, we have discussed how, when we talk about free from material misstatements, how the interplay of quantity and quality of evidence, and of course, the very concept of materiality would come into play. But this time, let's highlight on the phrase applicable financial reporting framework. Now, there are actually two types of financial reporting frameworks. There is one that we call a compliance framework, and the other one that we call a fair presentation framework. So when we talk about the compliance framework, it does precisely that. It simply complies. The client or management or the responsible party for the FS simply complies with what is asked in the framework. Nothing more, nothing less. Compliance only. But when we talk about fair presentation framework, actually in a fair presentation framework, the client or management is allowed to provide more than what the framework requires, and it may even be allowed to deviate from the requirements of the framework in those rare instances. And I repeat, the areas for deviation are expected only for those very rare instances where complying with the framework would lead to materially misstated financial statements. So we get to see under a fair presentation framework, while it does start with the minimum, and the minimum, of course, is compliance, but from the minimum, the client may provide more or the client may even provide less in very rare instances. All right, so when the client decides to provide more, for example, the client provides additional disclosures or discloses additional information, then the client needs to acknowledge these additional provisions or additional information either implicitly or explicitly. However, if the client decides to deviate or provides less than what is required, there is a need for the client to explicitly acknowledge the following things. Number one, that despite and in spite of the deviation, the financial statements are still fairly presented, that all the other standards are complied with. Remember, we only expect this to happen in rare instances. And so, therefore, if this does happen, it normally relates to either one or two or more, but not all the standards. So, client or management must explicitly acknowledge that all the other standards are complied with. They must also explicitly acknowledge and identify what particular standard is affected, what was the reason for the deviation, and what alternative treatment was used in place of or in lieu of the said deviated standard. And also the financial effect on each line item for each year presented to show the readers what would have been the balances had the standards been followed versus what are now the balances since the client has decided to deviate from the standards. So, again, whenever a fair presentation framework is used, the client may either provide more or less than the framework. Now, you might also acknowledge at this point that your PFRS or your IFRS actually falls under the umbrella of a fair presentation framework. If you have recalled your discussion on the conceptual framework for financial reporting, I'm pretty sure that was also mentioned that in rare instances, management may deviate from the requirements of the standard, provided that they explicitly acknowledge the items we have just mentioned. So let's now go back to the audit opinion. Now, the audit opinion may either fall under the category of unmodified opinion, and when we say unmodified opinion, this would of course refer to what we previously know of as the unqualified opinion or the clean opinion in our jargon. So, of course, there is also what we call modified opinions or the modifications to the opinion. So, the unmodified opinion or the unqualified opinion is given when the financial statements are free from material misstatement. So that's why we have to be very careful when we use the terminology clean opinion, because some people might misinterpret it to mean that the financial statements are already perfect. So when we say clean opinion or unqualified opinion, it simply means they are free from material misstatements. Modifications on opinions or modified opinions, on the other hand, can be given because of either of these two reasons. So these are the reasons why auditors modify the opinion. Number one, it could be that the financial statements contain material misstatements. And when we talk about these material misstatements, this would also involve violations of the standards, such as, for example, when the standards require particular disclosures to be made and the client refuses to make the disclosure, that will fall uh, under the reason of material misstatements. So, misstatements here do not simply refer to a difference between the recorded values versus the values required by the standards, but they may also refer to violations of the standards. The other reason, of course, is a scope limitation. And when we talk about the scope limitation, we're basically referring to the limitations imposed on the procedures that the auditor may perform or can perform or has performed. Okay, so these are the two reasons why auditors modify their opinion. And I think at this point, this must be a very familiar illustration to you in order to highlight when the auditor gives these different modified opinions. Of course, we have the qualified opinion, we have the adverse opinion, and then we have the disclaimer of opinion. Notice that a qualified opinion does not care about the reason. The only thing that the qualified opinion cares about is that the misstatement is material, the scope limitation is material, but it is not pervasive. So, regardless of the reason, for as long as the effect is material but not pervasive, the auditor may give a qualified opinion. However, when you talk about opinions that are on the extreme side of the spectrum, such as adverse opinion, an adverse opinion is when the auditor will opine that the financial statements are not fairly presented. A disclaimer of opinion, on the other hand, is an auditor's version of a no comment. I can't give an opinion. So, between adverse and disclaimer, the reason for the modification would now matter. So, an adverse opinion can only be given if and only if the reason is born out of a material misstatement, the effects of which are both material and pervasive. When we say pervasive, that means to say it is not isolated, it is contagious, so to speak, the effects of which are contagious all throughout the entire FS, so to speak. So, an adverse opinion can only be given in the case of misstatements that have both material and pervasive effects. A disclaimer of an opinion, on the other hand, may only be given if there is a scope limitation, and the scope limitation's effect is both material and pervasive, meaning to say the procedures that the auditor is allowed to perform are so limited that at the end of the day, the auditor might conclude that they were not really able to perform an audit. And because the limitation, the scope was so limited, they were not able to perform a satisfactory audit. Therefore, the auditor cannot rightly give an opinion. And so the auditor would simply disclaim an opinion. So these are the modifications to the opinion: qualified, adverse, and disclaimer. But before we move on, let's take a look at scope limitation just a tad bit. Okay, so when you talk about scope limitation, actually, it can be a scope limitation that is imposed by circumstances. So when we talk about imposed by circumstances, that means to say beyond the control of the client, beyond the control of the auditor. And there could be scope limitations that are imposed by the client. Okay, so the first one is imposed by circumstances, the other one is imposed by management or imposed by the client. Now, should the scope limitation be imposed by the client or be imposed by management, then the auditor must first endeavor to withdraw from the engagement. Take note that this is only the case if the scope limitation is imposed by management. Remembering, of course, that upon the start of this engagement, management agreed to the premise of the audit, and part of this agreement was for management not to restrict the auditor's procedures. So, if suddenly the if suddenly the auditor finds that management is actively restricting the scope, then somewhere somehow there must have been a disagreement, and so therefore should initially first try to withdraw from the engagement. If not allowed to withdraw, then the auditor disclaims an opinion. All right, so that is about the audit opinion. Let's now take a look at the audit report. So for the audit report, we do have a number of standards that we have to brush up on. And of course, the mother standard of the audit report is PSA 700, talking about the standard unmodified report. So very quickly, let's just outline what are the contents of the standard unmodified report according to PSA 700, starting of course with the title, and the title must clearly state that it is the work of an independent auditor. Ergo, independent auditors report. Followed by the addressee, and the addressee are generally the board of directors, the shareholders, or the third party requesting the audit. Now, I repeat, it is not considered as a good practice to address the audit report to a specific member of management. Okay? Because again, it's a report of the independent auditor intended for public consumption. And so, therefore, if a specific member of management is mentioned, it is usually accompanied by, say, for example, the BODs or the shareholders. For example, we normally see audit reports addressed to the president and the board of directors of XYZ company. Okay, so that is for the addressee. Following the addressee, we will have the auditor's opinion, and this shall have a heading opinion. Assuming that this is prepared according to PSA 700, meaning to say the opinion is an unqualified opinion. So the heading shall simply be opinion, and this is made up of two parts. The first part being what we traditionally know of as the introductory paragraph, and the second part, which really contains the opinion of the auditor. So the purpose of this section is to identify the client, state that the financial statements have been audited, refer to the FSS or the titles of each FS that is being audited, including, of course, the date, and a reference to the notes and significant accounting policies. More importantly, it should state the opinion of the auditor. Now, following the auditor's opinion section is the basis for opinion. And take note, under PSA 700, the basis for opinion will be present regardless of the type of opinion given. Now, we need to highlight that one because in the older version of PSA 700, the basis for opinion will only come out if and only if a modified opinion is given. However, right now, the basis for opinion will be present even if the auditor gives an unmodified report. And the basis for opinion always follows the auditor's opinion section. So the heading for this paragraph shall be basis for opinion, and the purpose of this paragraph will be to make a reference to the PSAs. So this is actually the very first section where we refer to our auditing standards. It also refers to the section on the auditor's report where readers will find a discussion on the auditor's responsibility. It will make a statement about the auditor's independence and states that sufficient and appropriate audit evidence has been obtained. Again, we are still in PSA 700. The assumption here is that the opinion is an unqualified opinion. Then we have what is known as the material uncertainty relating to going concern paragraph, for the MURGC paragraph. This used to be an emphasis of matter paragraph. Okay, so in the old standards, this used to be called as one of the many EOMs, or emphasis of matter paragraphs. But right now, they are given prominence by really having a separate title to it. So this is titled MURGC. Okay, but this will only come out as needed. So you will only see this paragraph if and only if, number one, the use of the going concern is appropriate, but there is a substantial doubt, and number two, the substantial doubt is adequately disclosed. Okay, and accounted for. So only in those two instances will the MURGC be seen in your audit report. And then we have key audit matters, and we'll talk a little bit more about this in the next few slides. Key audit matters are required only for audits of listed entities. Following that, we'll have the responsibilities for the FS, and to this we highlight that it is not only management who has the responsibility for the FS, but also those charged with governance, particularly for their oversight function. So this section will describe management's responsibilities for FS preparation, including design, implementation, and evaluation of internal controls, and the assessment of going concern. This will also refer to the oversight functions of TCWG, or those charged with governance. So following that, we have one of the lengthiest sections of the audit report, and that is the auditor's responsibility section. Now, this section is quite lengthy because it states the overall objectives of the audit. It refers to reasonable assurance. It refers to the sources of misstatement, that is, of course, fraud or error, and materiality. It refers to professional skepticism and professional judgment, and it gives a brief description of the audit process. So if you can just imagine, this particular section would try to summarize and give in for example, one or two paragraphs or more, a brief lecture about the audit process. This is the reason why it is so lengthy. And because of that, the standards are giving us an option as to how to present this particular section. So according to our auditing standards, this may be presented in the body of the report, meaning as part of the face of the audit report, or it may be presented as an appendix to the audit report in order perhaps in an effort perhaps to declutter the audit report, or it may be through a specific reference to a permitted location, such as, for example, the website of a regulatory agency. Okay. In the Philippines, we do not yet have this specific permitted location because this has to be approved by law and regulatory agencies. We do not yet have this one. Okay, so currently our auditors are choosing between at the body of the report or as an appendix, but it is good to know that the standards are providing us with a third option, and that is, of course, to make a specific reference to a permitted location in like the website, okay, of a regulatory agency. All right. So after that, we will have other reporting responsibilities. Now, this will not always be present, but in case that it will be present, then there shall be a subheading report on other legal and regulatory requirements. Now, please take note that the presence of this section will trigger the presence of a heading before the opinion that will state report on the audit of financial statements. So it's kind of like to differentiate those sections of the report which covers the FS and that section of the report which now covers other reporting responsibilities. So these two subheadings, or there will be two subheadings present. The first one before the opinion paragraph, report on the audit of the FS, and then this one, other reporting responsibilities, will have a heading report on other reporting responsibilities, assuming that the auditor has other reporting responsibilities. Needless to say, but we're saying it anyway. If there are no other reporting responsibilities, then there will be no subheading before the opinion section. Okay, so after that, we'll have the name of the engagement partner. So our standards would, of course, require that the audit report should contain the name of the engagement partner, but this is with a harm's way exception. Meaning to say, should putting the name of the engagement partner, indicating the name of the engagement partner, cause undue harm to the partner, then it is allowed. Okay, the partner is allowed not to be named. So that is what we mean by a harm's way exception. So the partner signs in the name, in the personal name of the partner and or the personal name of the firm. Okay, so either the name of the partner, the name of the firm, or both. Then followed by the auditor's address. This is the location in the jurisdiction of the auditor's practice. Let's just say, for example, the city where the auditor practices or maintains his audit practice. And lastly, there will be the date of the auditor's report. Now, usually we do point out that the date of the auditor's report is so important because this fixes the responsibility of the auditor to obtain sufficient and appropriate evidence. Now, the audit report should be dated no earlier than when the auditor has obtained said sufficient and appropriate evidence and management has approved the financial statements. So, generally, the approval date of the FS coincides with the date of the auditor's report. Okay, so that's generally the case. So, this is PSA 700. So, these are the parts of the audit report according to PSA 700. Let's now pay PSA 701 a visit. PSA 701 will talk about key audit matters, and key audit matters are those matters that in the auditor's professional judgment were of most significance in the audit and the financial statements of the current period. Two things: most significant and of the current period. Now we get perhaps to wonder, where does key audit matters come from? Where is it sourced from? So key audit matters actually come from matters communicated to those charged with governance. Now there are four items that are to be communicated to those charged with governance. According to our standards, we need to communicate our responsibilities as auditors, the planned scope and timing of our audit, the significant findings, and of course, the auditor's independence. Key audit matters will come from significant findings. So, generally, this will be those items that involve, for example, significant management judgment, and those which are subject to significant auditor judgment, significant estimates, significant risks. So, key audit matters will be sourced from the significant findings. And from these significant findings, the auditor will then filter it to matters that required significant audit attention and will filter it further into matters that are of most significance. So, those matters that are the most significant, they will be part of key audit matters. Remember again that KAMs or key audit matters are required only for audits of listed entities. However, it is possible for an audit firm, to voluntarily present as well KAMs for non-audits or non-listed entities, but the requirement is really for audits of listed entities. Okay, now KAMs may also interact with other sections of the audit report. For example, CAMs may interact with modifications to the audit opinion. Now, if something is so material that it was able to change the opinion of the auditor, then we know that that by itself is most significant, right? But then because of the severity of its significance, if you can call it the most test of the most significant, then they will already be given prominence in the basis for modification section. Okay, so matters that cause a modification to the audit opinion, whether qualified or adverse, are CAMs in themselves. However, they are given prominence by placing them in the basis for qualified or adverse opinion paragraph. As such, they should not be in the CAM section. They should be given their own place. They should be given the spotlight, because imagine they were able to change the opinion of the auditor. They were able to modify the opinion of the auditor. Now, what about in instances where the auditor gave an adverse opinion? Now, we said if it is an adverse opinion, then that means that the entire financial statements are not fairly presented. So, generally, if it's an adverse opinion, we expect there to be no other CAMs. That's the general expectation. However, in instances whereby the auditor still would like to present CAMs, even if they have given an adverse opinion, that is allowed. Okay, general expectation, no other CAMs, but if in case the auditor, in his judgment feels that there need to be CAMs presented, then that is allowed. But please make sure that the presentation of the CAMs do not overshadow the qualification or the modification of the opinion. Okay, so readers should not be led to believe that the FSs are more reliable than they actually are. So make sure that they do not overshadow the adverse opinion. Now, notice what we have been mentioning so far are qualified or adverse opinions. There is no mention of a disclaimer of opinion, because recall that if the auditor gives a disclaimer of opinion, the auditor is in effect saying, I was not able to perform a satisfactory audit. And so, therefore, if the auditor was not able to perform an audit, then there should be no CAMs, right? So, in the case of disclaimer of opinion, no CAMs. There should be no key audit matter. Now, in cases whereby comparative financial statements are presented, remember the definition of CAMs? Okay, they are of most significance in the audit of the financial statements of the current period. That means even if comparative financial statements are presented, CAM determination is limited only to the current period. Okay, because as a definition would say, it is only for the current period. Now, in case of key audit matters and emphasis of matter paragraphs, once an item has been covered in CAM, it should only be covered in CAM and cannot therefore be the subject of an EOM or an OM. So CAMs, they're a little bit jealous, they're a little bit possessive. Once an item is covered in CAM, it should not be the subject of EOMs or OMs. Now, should the auditor wish to highlight something that is in the CAM, if the auditor wishes to draw prominence on a particular CAM, then the auditor does so within the CAM section, perhaps by placing it at the top, okay, of the list of CAMs. But it cannot be that a CAM is the subject of an EOM. Not allowed, right? So these are key audit matters. Let's now take a look at the modifications to the opinion. And for this, we are simply going to differentiate what are the provisions of PSA 705 versus that of what we have previously known of in PSA 700. So we have opened up columns for qualified opinion, adverse opinion, and disclaimer of opinion. Note that for the title and the addressee, there is no difference, regardless of whether you gave unqualified or modified opinion, the title and the addressee remain the same. For auditor's opinion, however, the specific heading will now identify the type of opinion given. So recall in PSA 700, the heading was simply opinion. This time, the heading will be qualified opinion, adverse opinion, or disclaimer of opinion. Okay, so we now name the specific opinion that is given. And of course, proper wording is used to indicate the modification. In the case, for example, of a qualified opinion in the Philippines, the terminology that we used is except for. So unlike other countries that use subject to, in the Philippines we go for the more forceful version, and that is of course except for. So follow the proper wording to indicate the modification. Now there is a special requirement in the case of disclaimer of opinion. Of course, the heading will be disclaimer of opinion, but in the introductory paragraph, remember the introductory paragraph, it normally states we have audited the financial statements of. But then notice if it's a disclaimer, you're basically saying you were not able to do the audit. And so therefore you cannot say we have audited. That's why in a disclaimer of opinion, what you would normally read is we were engaged to audit the financial statements of. Right? So that will be for disclaimer of opinion. Now, for basis for opinion, again, of course, the heading will change. You will have to specify what type of opinion is being given a basis for, say for example, basis for qualified opinion. Okay, and this section would normally start with a description of the reasons for the modification, and then it ends off by saying that the auditor was able to gather sufficient and appropriate evidence to provide a basis for whatever type of opinion. Okay, but in the case of a disclaimer of opinion, remember, you were not able to do an audit, therefore, you were not able to obtain sufficient and appropriate evidence. So, this section will only contain a description of the modification. All right, so that's for the basis for opinion. Followed by the MURGC. Remember that special paragraph that will only come out if going concern is appropriate, but there is a significant doubt. But then the significant doubt is properly accounted for and disclosed. So no difference regardless of the opinion given. In the case of KAMs, just highlight that in the case of disclaimer of opinion, no KAM. Okay, so if the auditor disclaims, there should be no key audit matter. Responsibilities for the FS, there is no difference regardless of the opinion we give. Management's and TCWG's responsibilities remain the same. For the auditor's responsibilities, in the case of qualified and adverse, it's the same as unmodified. However, for disclaimer of opinion, because the auditor was not able to perform an audit, so therefore was not able to obtain sufficient and appropriate evidence, and will of course make a reference as well to his independence. So the other sections, like other reporting responsibilities, the name of the engagement partner, the auditor's address, and the date of the auditor's report will remain the same, regardless of the type of opinion given. All right, so that is PSA 705. Let's now take a look at PSA 706. This one will be for EOMs and OMs, our emphasis of matter paragraphs and other matter paragraphs. At this point, let us recall that EOMs and OMs do not have the power to change the opinion. They cannot change the opinion, they cannot modify the opinion. These are simply additional paragraphs that are placed in the report in order to highlight some things. The main difference between the two is that an EOM highlights something, highlights a note. Okay, this highlights something found in the notes, but an OM highlights something that is not found in the notes. So if what you wish to highlight is found in the financial statements, you use an EOM. But if what you wish to highlight is something not found in the FS, let's say for example, you would like to highlight the fact that there was a predecessor auditor, you will not find that in the FS. So therefore, what you will use is an other matter paragraph. All right, I just needed to do a quick edit there. So again, for emphasis of matter paragraphs, this will draw the user's attention to matters presented or disclosed in the financial statements that is fundamental to the understanding of the FS. But when we talk about other matter paragraphs, these draw users' attention to matters other than those presented or disclosed in the FS that is fundamental to the user's understanding of the audit of the financial statements. So if it is an understanding about the FS disclosed in the notes, use EOM. But if it is fundamental to the understanding of the audit, the auditor's responsibilities, the audit process, and it is not, of course, disclosed in the notes, then use an other matter paragraph. So they are the same in the sense that they should not be CAM. Remember, CAM is jealous and possessive, so they should not be CAM. They do not modify the auditor's opinion. They do not have the power to change the auditor's opinion. If there are multiple EOMs and OMs, use appropriate headings. Let's say, for example, OM dash predecessor auditor, for example, and then OM dash if you'd like to highlight, for example, restriction in the distribution. Okay, so if multiple OMs and EOMs, use appropriate headings. And the location of this EOM and the OM will depend on what it is about, but it should never be before the opinion paragraph because nothing should come before the opinion. The opinion section should be the first major section of the audit report. All right, so those are the differences and similarities in EOMs and OMs. Very quickly, let's draw our attention to the standards. What do the standards say about the use of EOM and OM? What instances are there where EOMs are required? They are required by the PSAs if a financial reporting framework that is not acceptable but is required is used. That means to say there's simply no other choice because perhaps the regulatory bodies have required it, but then other than that, it would have not been acceptable, but because the client had no choice, so this will definitely be disclosed in the notes, so highlight it using an EOM. Or in the case, for example, of a special purpose framework. Now, we know our PFRS or the IFRSs are considered general purpose frameworks. Special purpose frameworks would refer to, for example, financial statements prepared using the cash basis of accounting, for example, or the tax basis of accounting, or the provisions of a contract. So these are special purpose frameworks. Again, the use of these frameworks are going to be disclosed in the notes. So to highlight that, you use an emphasis of matter paragraph. Then we talk about subsequent events. So when there are facts that become known to the auditor after the date of the auditor's report and the auditor provides a new or amended auditor's report, then an EOM may be considered to be used, especially if this particular subsequent event is highlighted in the notes to FS. Other circumstances that might merit the use of EOMs is when there is an uncertainty relating exceptional litigation or regulatory action, or again, in the case of a significant subsequent event between the date of the FS and the date of the auditor's report that the auditor wishes to highlight and that which is disclosed in the notes, or in the case of clients which are early adopters. So that will also be highlighted using emphasis of matter paragraph, or should the client, for example, suffer a major catastrophe. So these are the circumstances that are required and or are expected to have emphasis of matter paragraphs according to our auditing standards. So let's now move on to the other matter paragraphs. Let's take a look at the instances where other matter paragraphs are expected to be used, such as, for example, instances where it is fundamental or relevant to the understanding of the audit or relevant to the understanding of the auditor's reports. Okay, so the first one is understanding of the audit. This time is the auditor's responsibilities. Okay, then reporting on more than one set of financial statements, and then restriction on distribution or use of the auditor's report. So these are the four broad categories where the auditor may use other matter paragraphs. So just to give more specific examples on this one, such as, for example, planning and scoping considerations required to be communicated in the report. So we are not usually required to outline in our report our planning considerations, but should law require us to communicate it, then we will use other matter paragraph, okay, to draw attention to that. Or, for example, when the auditor is unable to withdraw despite material and pervasive scope limitations, such as, again, for example, when they are not allowed to withdraw by law. Okay, or by regulatory agencies. So, another matter paragraph will be used to highlight that one because this is fundamental to the understanding of the audit, not necessarily the FS. Or when the prior period is audited by another auditor, or when the prior period is unaudited, or when there is a material inconsistency between the FS and other information, and we'll be talking a little more about that in a few. And when you talk, for example, about dual dated amended reports to indicate the auditor's procedures are restricted to the subsequent event date. Although this is more commonly done through an EOM because usually this subsequent event is disclosed in the notes. But if what you would like to highlight is the auditor's responsibility in relation to dual dating, okay, and we'll talk about that under completing the audit, okay, then an OM is used. Or when the auditor is required to elaborate on matters to further explain the auditor's responsibilities, so again related to the audit and the auditor's responsibilities, or reporting on financial statements prepared under two different acceptable financial reporting frameworks, and when the audit report is restricted for use. So notice that all of these things actually refer to instances that will help the user understand the audit and the audit process and the auditor's responsibilities better. As compared with emphasis of matter paragraphs, under emphasis of matter paragraphs, this would help the users understand better the financial statements. And that is why these are disclosed in the notes and should be highlighted using EOMs. All right, so that will be for PSA 706, the use of additional paragraphs, EOMs, and OMs. So that's about it. That's our PSA 700 series, starting from the standard and modified report, key audit matters, modifications to the opinion where we saw qualified adverse disclaimer, and of course, other paragraphs such as EOMs and OMs. But the story does not stop there. We do need to talk about the other standards that will have an effect on the audit report. Don't worry, this will be quick. Starting, for example, with PSA 510 on opening balances, the responsibility of the auditor is to read the most recent FS and the predecessor auditor's report. The auditor, the current auditor, must also obtain sufficient and appropriate evidence with pertaining to opening balances and whether they do not contain material misstatements. At this point, we get to appreciate the interrelatedness of the FS, not just across accounts, but within the balance, right? Because the beginning balance or the ending balance of last year, which it becomes the beginning balance of this year. And so, therefore, if the beginning balance of this year contains misstatements, well, most definitely the ending balance would also be misstated. So, the auditor has an obligation, a responsibility to obtain sufficient and appropriate evidence about the beginning balances. So the auditor should also perform one or more of the following: review the predecessor's working papers, evaluate whether the current year procedures provide relevant evidence on beginning balances, because it is possible, right, for current procedures to give you evidence about the beginning balance, and perform specific audit procedures to obtain evidence about beginning balances. We again remember that if there is a defect in the beginning balance and that defect remains to be uncorrected, then the ending balance will also be defective or misstated. Such as, for example, when the auditor is unable to obtain sufficient and appropriate evidence on the opening balance, then the opinion on the ending balance or the current year under audit is expected to either be qualified or disclaimer, because this is owing to a scope limitation. Or if the opening balances contain misstatements and these misstatements have not been corrected, then the ending balance will also be given an opinion that is either qualified or adverse. Or when the current period's accounting policies have not been consistently applied in relation to the opening balance, there is a misstatement, right, to the opening balance. So therefore, if those misstatements remain to be uncorrected, then the current year under audit will include either a qualified or adverse opinion. Or if the prior period auditor gave a modified report and the reason for the modification remains unchanged, management has not corrected it, and it has remained to be relevant, then modify the current year opinion as appropriate. So, depending on what opinion was given on the beginning balance and what is its impact on the ending balances. So, we get to see the relationship here of the beginning balance as well as the ending balance. Next, let's talk about audit of Group FS. And for the audit of Group FS, of course, if you think about consolidated financial statements, for example, where there are components. So when we talk about components, we refer to affiliates, subsidiaries, branches. Eventually, the financial statements will be consolidated. So there has to be a decision made as to who will act as the group auditor. Okay, so the group auditor will be the one to sign the audit report on the consolidated financial statements. It is the group auditor's responsibility to communicate scope and timing with the component auditors. Again, component auditors refer to the auditors of the branches, subsidiaries, okay, affiliates, etc. Okay, and then the group auditor must also obtain sufficient and appropriate evidence about the financial information of the components, including the consolidation process. Remember that in the Philippines, the group auditor cannot divide responsibility with the component auditors. We have to mention this one because in some jurisdictions, like in the United States, for example, the group auditor may divide responsibility. And they usually do the division of responsibility in the introductory paragraph, where they will, for example, say, we have audited the financial statements of XYZ consolidated except for subsidiary A, which is audited by another auditor. So you may be able to come across those illustrations in some foreign authored books, particularly in the US, for example. But in the Philippines, the group auditor cannot divide responsibility with the component auditors. Ergo, the group auditor must be satisfied as to the work done of the component auditor, the component auditor's objectivity as well as competence. And if the group auditor is not satisfied, the group auditor may either perform the audit on the component himself, or may look at the effect of this component on the entire consolidated FS and whether it is material enough to warrant a modification of opinion. But at the end of the day, the group auditor simply cannot divide responsibility with the component auditors. All right. Now, moving forward to PSA 710 on comparatives, there are actually two frameworks for comparatives. There is what we call corresponding figures and comparative financial statements. So just remember that corresponding figures, they are the clingy ones. You know, they are those who would say, my life will not make sense without you. So they are not presented as a complete FS. They will only make sense if they are read together with the complete FS. So they are intended to be read in relation to the current year FS. They are therefore considered as an integral part of the current year FS. And because they are seen as part of the current year FS, the opinion of the auditor is only on the current year as a whole. The opinion does not make a specific reference to the corresponding figures. Because when the auditor looks at the financial statements, the corresponding figures are part and parcel of the current figures. They are not, so if we use our jargon, they are not separate entities. Okay, they are seen as part of, one with the current year figures. So the opinion is only on the current year FS. However, if you're looking at comparative financial statements, they are presented as standalone financial statements. Their presence is only intended for the readers of the report and the financial statements to be able to compare the financial position and performance of the entity throughout the years. So, therefore, the amounts and other disclosures are only there for comparison with the current. They do not form part of the current FS. Even if you cover or remove the current year FS, the comparative FS will still make sense. Okay? And because of that, the opinion is on each period presented. So, whereby the corresponding figures are the clingy ones, the comparative FSs, they refer to the strong, independent financial statements capable of standing alone. They will make sense with or without the current period FS. All right? Now, for the comparative FS, we have previously mentioned certain possibilities, such as when the prior period is audited by another auditor or the prior period is not audited at all. So, they will also form part of the discussion on comparative FS. If you are the continuing auditor, meaning to say you were the auditor in the comparative and you're also the auditor in the current, so it is your responsibility to update. So, it is not an automatic reissuance of the report, but to update and reissue the report. Now, if your report is is different from the previous. Say, for example, in the comparative FS presented, previously you gave a qualified opinion, but management has already corrected that in the current period and it no longer remains relevant. So you may wish to change your qualified opinion to an unqualified opinion. If there is a change in the opinion, or if the report is different from the previous, include an other matter paragraph. The other matter paragraph will simply highlight the fact that the opinion given has already been changed. All right. Now, it is also possible that there is another auditor or there was another auditor. So, there might be two possible scenarios to this one. You might find that the predecessor auditor is willing to reissue. And so, if that's the case, that would be very good news for us. However, most often than not, the predecessor auditor will no longer like to reissue. And so if the predecessor auditor does not reissue, you will need to add an other matter paragraph. The other matter paragraph will simply highlight the fact that the prior year or the comparative FS presented is audited by another auditor. You don't need to drop names. It's enough that you say audited by another auditor. What was the opinion given by the other auditor and the date of the opinion. Now, if the opinion is other than unmodified, meaning to say if the previous auditor gave a modification of the opinion, then also a brief description of the reasons for the modification. Now, it is also possible that the prior period is totally unaudited. Include an other matter paragraph to highlight the fact that the comparative FS presented is not audited, and then perform audit procedures on beginning balances, such as that which we have previously discussed. Okay, so that is PSA 710 on comparatives. Let's now move on to PSA 720 on other information. Now, the auditor's responsibility is to simply read the other information. Say, for example, your audit report together with the audited FS is being made part of the annual report to stockholders. Okay, so your responsibility is to read the other information. We read the other information because we are on the lookout for inconsistencies. So once the auditor is able to detect material inconsistencies, and the auditor will be able to detect this by reading the other information, the auditor will then investigate which one needs the amendment. Is it the FS or is it the other information? Because it could be one of the two, right? When you see the FS reporting differently from the other information, you need to determine which one is telling the truth, which one needs the amendment. So, in case that it is the FS that needs amendment and management refuses to amend, take note that our opinion is on the financial statements, right? And so, if the FS needs the amendment and management refuses to amend, then the auditor may modify the opinion. And the modification may either come in the form of a qualified or adverse opinion because you were already able to see the material inconsistency. However, it may be possible that the financial statements are correct and that the inconsistency and the amendment is needed on the other information. Meaning to say the FS is correct, there's no problem, our opinion is safe and sound. The amendment is needed on the other information. However, the other information is not part of the scope of our audit. So in this case, we cannot modify our opinion because the opinion is on the FS and the FS is okay. So what can the auditor do? Number one, the auditor may decide to add an other matter paragraph, okay, to highlight the material inconsistency, or the auditor may decide to withhold the audit report until management corrects the material inconsistency, or the auditor may decide to withdraw from the engagement, especially in instances whereby the integrity of management is now put into question. Okay, take note again that when it is the other information that needs the amendment, we cannot modify our opinion because the FS is correct. Okay, and it's also possible for the auditor to see material misstatements of fact. Now, when we talk about material misstatements of fact, these are inconsistencies found in matters that are not related to the FS. So, a while back, we have been talking about material inconsistencies, and this would affect, or these are matters that have an implication or affect the FS. Material misstatements of fact, however, are items or matters containing inconsistencies that do not have an effect on the financial statements. So if this is the case, then the auditor should notify the audit committee and seek legal advice if necessary, recognizing, of course, the fact that this is not in any way related to the FS with which our scope is bound to. Okay, so that is PSA 720 on other information. Now let's talk about the last three PSAs here: PSA 800, 805, and 810. When we talk about special purpose FSs covered by PSA 800, examples of this are tax basis, cash basis, contract provisions, or regulatory requirements. In contrast to general purpose FSs, special purpose FSs are intended for a specific group of users. Now, the auditor will still follow the same PSAs, but remember, because we would like to highlight the fact that what is used is a special purpose framework, we highlight this by pointing to the note disclosure. And so, therefore, an EOM is necessary. Consider as well restricting the distribution of the audit report. And if what you would like to highlight is the restriction on the distribution, then an OM will be used. Now, in the case of a single FS or a specific element, say for example, you have a prospective client who only wants you to audit the balance sheet only, okay, not the other FSs, or audit only assets, for example. Now, the said engagement may be accepted provided that the prospective client is also aware that even when you are only auditing, say, for example, the balance sheet, then you may need to look at other accounts because the accounts are interrelated anyway. So you may accept this engagement provided the client is aware and agrees that your scope should not be restricted. You can still check on the other accounts which are related to the account under audit. Okay, so confine the materiality to the specific FS and specific element, single FS and specific element, meaning to say have a different materiality or a different threshold. Because definitely, when you talk about auditing assets only, you would have a different materiality as to auditing the entire FS, right? And then the opinion to the single FS or specific element should be clearly outlined that it is limited only to the specific FS and the specific element, but you need to examine related accounts. Now, in order to ensure that users will not be misled into thinking that you audited the entire FS, then your report to this should be separated from your report to the complete FS. Okay, so report should not accompany the financial statements. Now, in the case of summary financial statements, the auditor may accept this only if the auditor expressed an opinion on the unabridged. If you can imagine summary FSs, instead of seeing line items, perhaps what you will see there is current assets, then the balance, non-current assets, then the balance, total assets, then the balance, right? So the auditor is only allowed to accept an engagement to report on the summary FS if and only if the auditor is also the one which audited the complete set of financial statements. Okay, so if the opinion on the unabridged is adverse or disclaimer, note that adverse or disclaimer of opinions, they are at the most extreme end of the spectrum, right? This already covers the entire FS. Either the entire FS is materially misstated or you have not audited, okay, the entire FS. It's on the extreme end of the spectrum. So if the opinion on the unabridged is adverse or disclaimer, it is not appropriate for you to report on the summary financial statements. All right, so that's about it. Our quick run through on audit reports. Now I know that doesn't seem too quick. I think we're nearing our 1 hour mark, but there are a lot of standards relating to audit reports. We took out the essentials and presented them here in our snapshot. So thank you so much for joining me, and I hope to see you in our next snapshot.